Thank you everyone for joining us today for the financial state of Canadians and how you can leverage data for good to raise more funds in 2021. My name is Alan Davidov, VP of Business Consulting and Not-for-Profit Lead here at EA. And I want to introduce our speakers before we get going. First and foremost, I want to introduce Karin Martin, who's our VP of Data Development. Her and her team are responsible for the financial data at EA, and she's perfectly suited, and really it's great to have her here to talk to you about the financial state of the country and Canadians in 2019 and the early parts of 2020 through the COVID period. Again, my name is Alan. I lead the not-for-profit sector business, and also with us, last but very not least, is Jennifer Robbins, our Senior Manager of Account Management and the lead for the not-for-profit business as well. For our agenda today, we'll walk everybody through sort of the financial state of the nation entering 2020. How were Canadians doing? How did things look across the board from assets to other financial variables? And then we'll talk a little bit about 2020 itself and showcase the first 3 quarters of 2020. First time ever. This will be sort of a VIP sort of insight into how Canadian household balance sheets looked. So we'll give you a preview of that before the data is fully launched later this year. Then we'll also introduce 2 new products, which I'm super excited about, WealthTrends and WealthTransfer. And then last but not least, we'll talk through a case study about how you can use WealthScapes Fundraiser and DonorRank together to help you reach your goals. So with that, I'm going to hand it off to Karin to get us started.
All right, thanks, Alan. So I'm going to jump right in with Wellscapes. So for those of you who are not familiar with Wellscapes, it is currently in its 13th iteration. It's the most comprehensive database available on Canadian household assets, debts, and income statistics. The data, which is available at the neighborhood level, is built using the most current and authoritative data sources, including data from the Bank of Canada, Statistics Canada, and Equifax. It was designed to help provide marketers with a better understanding of their customers' financial behavior, including market share and wallet share. So before we jump into how the pandemic impacted Canadians, we're first going to take a look back at how the year began. Breaking down household net worth into the 6 major dimensions, we're able to get a clear picture of the Canadian financial landscape before the market and behavior shifts that occurred as a result of COVID. This information is important to understand why we may be seeing some of the changes and different trends that we're seeing emerge. So Wellscapes allows us to break down net worth into 3 major sections: liquid assets, which is further broken down into savings and investments, debt, which is broken down into consumer debt and mortgage, and non-liquid assets, which can further be broken down into real estate as well as pensions. So if you can recall taking a look all the way back at 2018, it seems like a long way ago now, but at the end of 2018, we did see a fairly significant drop in the equity market, and Canadians felt the impact of the drop, with most households ending 2018 with net losses in their liquid asset portfolios. However, throughout 2019, we saw the equity market rebound and reach higher levels than it ever has before, which contributed to significant growth in average Canadian liquid assets over the year. So here we're looking at a snapshot of what Wellscapes has to offer. These values are national averages. So all of the major indices we can see are showing non-trivial growth. So it's not a surprise to see that we're seeing the Canadian average net worth was up from the end of 2018 to the end of 2019. So right before the pandemic hit, Canadian average net worth was up about 5.6%. The rebounding equity market contributed to the growth in investments, and a strong performance in fixed income markets resulted in an increase in pension values. We saw a minor increase in real estate values, which are more or less set off by an equal increase in mortgage debt. So nationally, like I mentioned before, 2020 started off well. All things were looking good. We had across the board, we saw an average increase in net worth of 5.6%. And while things did look good nationally, there's a few notable differences that we're going to highlight here. So Quebec led the pack with the highest average increase in net worth, followed by Ontario and the Atlantic. While BC remains the province with the highest average net worth, they saw the smallest year-over-year growth of only 1.2%. The combination of BC's less than great growth and Ontario's surge forward led to the gap between the two provinces' average net worths closing. It's historically set at about $150,000, while this at the end of 2019, it closed to $100,000. Looking at other major cities, Montreal leads the way with the largest growth, followed by Ottawa, Southwestern Ontario, and Quebec City. The net worth growth in these areas occurred at the same time as the resurgence of Canada's manufacturing sector. It's also worth taking a look at Vancouver and noticing that it's the only major city in Canada to experience a year-over-year drop in net worth. In addition to there being quite a bit of variance amongst the provinces in average net worth, there's also some distinct differences in their net worth composition. BC has the highest proportion of their net worth tied up in non-liquid assets, while Alberta and other prairie provinces prefer liquid assets. Vancouver and Toronto households remain heavily invested in real estate, while the remainder of Ontario tends to have a more balanced portfolio between liquid and non-liquid assets. Naturally, because BC and Ontario are more invested in real estate, their net worth values fluctuate more with the real estate market, while the prairie provinces, specifically Alberta, are more impacted by stock market fluctuations. Central Canada had a good year, with many of their components of their portfolios trending in a positive direction. Ontario and Quebec benefited from real estate, pension, and liquid asset growth that generously offset their minor increases in debt. Alberta, Saskatchewan, and Manitoba all saw liquid assets grow with minor decreases in real estate values. However, they also saw almost no increases in debt, which also left them with net positive net worth values. British Columbia, and more specifically Vancouver, felt the drop in the real estate market, given their asset distribution is heavily invested in real estate, like I just mentioned. Nationally, Canada only saw a minor increase in average real estate values that was roughly in line with inflation. Taking a closer look at the provinces, we can see that real estate in Western Canada saw a net decrease over the year, with BC having the largest drop. In Central Canada, both Ontario and Quebec saw the largest increases in average real estate value. In Atlantic Canada, while the region as a whole shows little year-over-year change, we saw PEI real estate values grow by 7% and Newfoundland and Labrador values drop by 5%, which both contribute to the net zero change. Of Canada's major cities, Vancouver saw the largest drop in average real estate values, and it appears the city, which has historically had a booming real estate market, is cooling off. While Toronto's real estate market continued to increase, Ottawa and Southwestern Ontario benefited the most from growth in average real estate prices. Nationally, there was little change in Canadians' debt to disposable income ratio. However, we do see households in Ontario taking on more new debt than the rest of the provinces. Households in Saskatchewan appear to be taking a step back from accumulating new debt and saw almost no change in debt per household, leading to a drop in debt to disposable income. Ontario's debt was up 5.1% per household, with mortgage and personal loans being the highest contributors to the growth. And disposable incomes growing at a slower pace, we can see that the increase in debt to income ratio. Southwestern Ontario and Ottawa both saw a 6% increase in average debt per household, largely due to mortgage and personal loan growth, which each grew 7% per household. In the past, we're used to seeing mortgages in real estate, the mortgage to real estate ratio drop. However, this year we're seeing them grow, a shift that can largely be attributed to the tepid real estate market rather than a very active mortgage market. The average increase in real estate value was roughly $4,800, while the increase in mortgage balances was roughly $4,100 per household. Taking a closer look at mortgages as a share of real estate, we can see that with the exception of Quebec, mortgages grew faster than the real estate values. All right, so now we're going to touch base on WealthTrends, which is one of the new products that Alan mentioned. And we're excited to introduce this product as it captures a little bit more of what was going on as the result of COVID. It's the newest financial data product to our suite. So that, as we know, the pandemic has rapidly changed the economic landscape and consequently household balance sheets. WealthTrends was designed to help stakeholders understand how these changes have impacted Canadians and their financial decision-making. The product offers quarterly updates to key financial statistics at the neighborhood level. It was created with the most up-to-date data that captures the impacts of the pandemic and is controlled to authoritative control totals. So I'm sure we can all recall that sharp drop in the market that occurred in March, following the government mandate to cease or change operations of many businesses. During the first quarter of the year, we saw the market drop at an astounding pace to the lowest levels we have seen in the past 4 years. As we will see, Canadian households experienced a significant loss in their liquid assets in the first quarter. However, unlike the economic crisis in 2008, most of the market indicators have rebounded within the second and third quarters. Specifically, we saw the equity market begin to rebound early in the second quarter. And naturally, the fixed income market was less impacted by all of the rapid change and saw a notable increase relative to the start of the year. Also noteworthy is the increase in the real estate market. We will see later on how many Canadian households are experiencing good fortune due to non-trivial growth in average real estate values. So here's a snapshot of what our WealthTrends product looks like. Again, it's a snapshot of average Canadian household balances. We're showing quarter over quarter change as well as average per household. Most notable to me is the 4.7% drop in average net worth we saw in that first quarter, followed by the 4.7% increase or rebound that we saw in the second quarter. The third quarter was also up 2.9%, which net out to an average increase in net worth of 5.4% relative to the beginning of the year. The other number that stands out to me on this sheet is the year-to-date increase in savings, which is up 10% relative to the start of the year. We know that this increase is largely due to both increased government transfers as well as reduced spending. We saw consumer debt decrease through the first 2 quarters, but by the end of the third quarter, we're seeing Canadians begin to accumulate more debt once again. And we'll also take a closer look at that 6.4% year-to-date growth of average real estate. Most impacted by the net decrease in equities were Alberta, Saskatchewan, and parts of the North, which all wrapped up the second quarter with lower average net worth values per household than the start of the year. Looking at Canadians' major cities, Toronto, Ottawa, Southwestern Ontario, and Montreal have seen the most growth and are entering the back end of the year better off than they started, despite the economic challenges stemming from the pandemic. Specifically, Ottawa is the front runner with an average increase in net worth of 9%. Calgary, Edmonton, Saskatoon, and Regina were all hit the hardest due to from the pandemic. These cities in the major provinces are known for their oil production and all experienced a drop in their average net worth through the first half of the year. Here we're taking a look at some of the different shifts in each of the key dimensions contributing to net worth. We can see that the shifts in average net worth are most closely linked to the changes in real estate values. In each of the areas we're seeing significant growth in real estate, we're also seeing the largest shifts in net worth. As I previously mentioned, by the end of the third quarter, we saw a 6.3% increase in average real estate values. Lingering uncertainties around the equity market and remote work becoming more common have made real estate investments an appealing option. In addition to many people looking for a more spacious alternative to their condos or apartment spaces, we have also seen 3 drops in interest rates since the onset of the pandemic, which makes home ownership more accessible to many Canadians. Ontario and Quebec have benefited from the largest from increases in real estate holdings, with average values increasing by 9.1% and 8% since the beginning of the year. Meanwhile, Saskatchewan and Alberta were the only 2 provinces to experience a net decrease in real estate values. Of Canada's largest city, Ottawa-Gatineau is the front runner with an increase of real estate of 14%, followed by the households in Windsor and Montreal, each with an average growth rate of 12%. Toronto real estate market prices continued to march upward through the second quarter, but tapered off after the third and ended the year to the end of the third quarter at about 8%. Other major cities outside of Toronto are also seeing real estate values continue to grow. So in the Guelph, Barrie, Peterborough, just on the outskirts of the city, they're all showing above average growth as well. Nationally, we've seen the average mortgage dollars per household rise. This growth largely tracks the shifts in the real estate market. As I mentioned earlier, drops in the interest rates have made home ownership more accessible. The appeal of home ownership also continues to grow with the pandemic. Many Canadians are starting to view investing in real estate as a more safe investment vehicle that distances them from the potentially volatile market. Since the beginning of the year, we've seen national increases in demand in term deposits or savings and checkings account of 10.3%. In each province, we can see the average savings per household on the rise since the beginning of the year. Entering 2020, the average Canadian household held 34% of their liquid wealth in term and demand deposits, while the remainder was in the investment category. Well, at the end of the year, at the end of the second quarter, that rose to 37%, indicating a shift in preference to lower risk saving vehicles. In the third quarter, we saw the shares begin to shift back down, which is likely the result of fewer government transfers and consumer spending back on the rise. Looking across the cities, we're seeing a similar trend. That first quarter, we're seeing a drop due to the change in equity market. And over the second and third quarters, we're seeing the total balance back on the rise. You can also see a similar trend between the share of the 2 investment vehicles of checkings and savings versus investments. Across the board, we're continuing to see more money being held in the low risk vehicles. Nationally, in the heart of the pandemic and wrapping up the second quarter, average consumer debt per household dropped by 4.8%. With spending back on the rise in the third quarter, consumer debt began to creep upwards by about 3%, which left us at about a 2.4% decrease relative to the beginning of the year. At the beginning of the year and over the first quarter, when things were looking a little more uncertain, high interest credit card debt was down the most with a national drop of 13.5%, followed by personal loans, which were a drop of 2.4%. Households in central Canada have managed to pay off the most debt, with decreases in average debt of over 3%. Taking a look at Canada's major cities, we continue to see the trend of consumer debt being paid off. Households in Ottawa have the largest overall drop in consumer debt of 4.8%, which largely can be attributed to the 17% decrease in average credit card debt, while households in Vancouver also appear to be paying off their credit card debt quickly with a 15% drop per household. So that's the summary of how things are looking over the first 3 quarters of 2020. So 2019 was a great year for Canadians. Coming into the pandemic, all looked great. Net worths were up. At the start of the pandemic, there was a pretty big drop in the equity market that took a toll on Canadian investments. But over the first 3 quarters, we've seen the market rebound and significant change in growth in the real estate market. And we've also seen increased government transfers, which contribute to larger balances in liquid asset vehicles, liquid assets and savings vehicles. It's important to keep in mind that what we're looking at here is the average Canadian net worth values and changes. It does look like a very positive outlook, but we also have the capability to take a look at these numbers at a neighborhood level, where we can see certain areas that may be more at risk to some of the negative impacts on the economy that we saw. So now I'm going to hand things over to Jennifer.
Thank you so much, Karin. Sorry, I had to unmute myself. I have to say, I absolutely love going through Wellscapes, and WealthTrends is just an added interesting layer, especially considering the climate that we're currently in. And I don't think Karin mentioned this, but that's actually the first time that we are presenting the Q3 results. So it's all kind of latest and greatest wealth data. So with this being said, I'm basically going to build on what Karin has shared about WealthTrends, and I'm actually going to apply it in the context of not-for-profit sector. Now, for many of you who know Alan and I, you know that our conversations with you generally start with questions such as, what are you trying to achieve? What are your goals? What's the overall strategy? And in today's climate, WealthTrends can certainly help you understand how your constituents would be negatively or positively impacted by lockdowns and closures, whether that's an increase in debt load due to job loss or an increase in liquid assets due to dramatic reduction in expenditures. So this more granular and point-in-time review, that quarterly update that Karin was referring to, can help with forecasting and planning for event teams, annual giving programs, or membership enrollment. Now let's talk about an example, partnering specifically WealthTrends with Prism. For those of you who are not familiar with Prism, it is our flagship product. It's a lifestyle segmentation system that captures demographics, psychographics, finances, lifestyle, and consumer behavior, even giving tendencies. What we have done at EA is we've basically taken all of our different data points, modeled it right down to the postal code, and identified 67 unique segments that we've brought to life in these little icons and personas. If you're interested in what your neighborhood is, please take a look at our website and do the Prism lookup. So with this being said, let's talk about our example. Meet Brian and meet Matt. So you can see here on the left-hand side, Brian, he's 33 years old. He's a medical student in residency. He rents a condo downtown. He's married with no children. You can see also his deposits within his bank, deposits, loans, credit card bill. You also see Matt on the right-hand side. He's 36 years old, coffee shop owner. He owns a suburban apartment. He's single. You can also see his assets at the bank. He has $45,000 deposits, and he has a $200,000 mortgage on a $450,000 home. Now, both of these look like very decent annual giving candidates. However, when you lay on WealthTrends, it paints a little bit of a different picture. What WealthTrends is going to show you is that because Brian, over here on the left-hand side, is a frontline worker, he's working all the overtime and following all lockdown restrictions, the debt that you see here is decreasing and that deposit is increasing. Now, Matt, on the other hand, his cafe has had to close due to lockdowns. And they're only offering takeout at this point in time, which has dramatically reduced the income that he's receiving from his cafe. He's needed to start dipping into that savings, that $45,000 you see in deposits, basically to stay afloat. So through the lens of an annual giving program, Brian is likely a better candidate for an ask today, given what WealthTrends is showing us. So we're going to switch gears now a little bit, actually a lot, and I'm going to talk to you about the brand new wealth transfer data set. So this is just released, brand new. I'm really, really excited to have the opportunity to share that with you. So why? So basically, what is wealth transfer? What are we looking to do? So today I'm going to talk about the transfer of wealth, basically that largest transfer of wealth in Canada that we're expecting, why we built wealth transfer, what it's about, how you can leverage it, and basically how it's going to, or how it could potentially impact or influence the not-for-profit sector. So let's start with some key trends. First, not surprisingly to anyone, we have an aging population. For any of you who's followed Dr. Doug Norris's demographic updates, you'll know this for sure. And what we also know from our social values data set is that many in this mature demographic would like to leave behind a legacy for their family, for their community. Now, the expected inheritance by 2026 is $1 trillion. This is in Canada. That's a huge, huge dollar value. Many of the recipients will be millennials, our favorite people to talk about. In theory, banks, investment firms, and insurance companies will be the biggest benefactors, although others, such as not-for-profit, real estate, automotive, and luxury goods, will also benefit from this transfer. Now, what we also know is that millennials think and behave differently from their parents and grandparents. Dr. Doug Norris, who I just referenced, he has been sharing and speaking about this for many years now. Millennials do not have the same trust in traditional brands that their parents or grandparents did, and they're often looking towards new and innovative products and services. So what does this mean for you? Now, if we look across the age distribution of Canada, we see the large boomer cohort sitting here in that lovely fuchsia color, age 55 to 74, and they represent 1 in 4 Canadians. Now, millennials and Gen Xers, the often forgotten Gen X, are also quite large and make up 40% of Canada's population. And they're the ones who are set to inherit the largest transfer of wealth from the boomers. Now, how money is transferring is also changing. It's reasonable to expect that a large proportion of monies transferred will be gifts. My children have just returned home. You can hear them in the background. It's reasonable to expect that a large portion of these monies will be transferred via gifts that will basically have a positive impact, we believe, primarily on home ownership among young Canadians. Many wealthy households want to see their children and grandchildren enjoy these gifts. Now, these gifts are going to be given while the person is still alive, rather than a bequest in a will, which is a big difference from years before. And things such as education, buying a home, or a car are going to be likely top on the list.
Hey, Mommy.
Now, there's more than $576 billion in inheritance that has been received by Canadians to date. Now, if we take a look at this chart here, this is a distribution of inheritance received by province. What's really shocking is if you look at British Columbia, $180,000 has been given, which is basically more than double the amount received in provinces such as Manitoba, Quebec, or Newfoundland. Now, when you layer on average net worth across the provinces, we do start to see a correlation between the two. Provinces like British Columbia and Ontario have high average net worth, likely driven by real estate, and they also have high inheritance values. Which then brings us to wealth transfer. So we created this product to answer the question of who is going to be the beneficiary of this wealth transfer, and also where are they? As you all know, we at EA are big fans of geography. So what is it? I've kind of kept you hanging long enough. So wealth transfer is a predictive model that scores postal codes on their likelihood to inherit money in the next year. Our model provides both an incidence and value score at the postal code level, like many of our other data sets. It is actionable at that granular level of geography, which means we can score your constituents on who is most likely to receive an inheritance and what that dollar value is. This data set took 10 months of development, and similar to our other data products, it will be updated on an annual basis. So we have a special guest joining us. This is my son, Liam. I'm going to finish chatting with him here with us. So where was it? I was talking about what is wealth transfer. And I talked about at the postal code level and being able to append this to your constituent database. Now, as with many of our other data sets, this was developed using privacy-friendly, of course, privacy-friendly financial survey and exclusive supplementary data from Statistics Canada. Now, our very, very talented modelers have worked on this, and they've modeled and validated this using advanced analytical techniques, enabling complete integration across all EA products and services. Otherwise meaning that you can leverage this wealth transfer data with any segmentation that you've completed, with any donor rank analysis that you've done, or marrying this to any other data set that you currently license. Now, when we're speaking of the total estimated inheritance, when annualized, $36 billion was projected to be transferred by form of inheritance in 2020, which is an incredible amount of money. Now, nearly 40% of inheritance is expected to be received by those aged under 54, which means that for marketers and for anyone wishing to communicate with these beneficiaries, you need to learn about them and know how best to speak with them. It changes that marketing and communication strategy. Now, with wealth transfer, you can also size the total potential inheritance market and where it can be found. Again, we are geography geeks over here. So now when we're looking at inheritance transfer on a provincial level, Ontario, Quebec, British Columbia, and Alberta collectively account for 85% of the total national inheritance, or roughly $33 billion. Not very surprising to see this percentage given the size of population as well. Things get a little bit more interesting when you start to layer on additional data points. So our model includes 3 different values. First is the incidence of receiving inheritance, so that count of households. The second is the total dollars, so aggregate dollars. And last is the average dollar. Now, because these data are available at the postal code level, we're of course able to view this through the lens of many different geographies, including any custom footprints. The chart that we're looking at here is the 3 different values through the lens of the top 10 CSDs in Canada. For those of you who do not speak geography geek, a CSD or a census subdivision is basically the city of. So when we're looking at Toronto, we're speaking of the city proper. Now the bar here in purple represents the potential by incidence, aka the number of households expected to receive an incidence inheritance. So with the line representing that total potential or that average dollar. So if we take a look here at Toronto, first city on the left, we see that it has the highest proportion of households receiving inheritance or flagged to receive an inheritance in the next year, while Vancouver, kind of in the middle, definitely has the highest average dollar value by a large margin. Now, when we go back to the question Alan and I always ask you, you can certainly align this with your fundraising goals and objectives. Now, with these data being available at the postal code level, which I've now mentioned probably a dozen times, it means that we're able to append this to your constituent records, which means that you can dive deeper into where the opportunity lies within your own database. So Alan's going to speak a little bit more about how wealth transfer can be an added layer to donor rank. And as you can see here, you've got the map and you've got the scoring. Now, going back to PRISM, that lifestyle segmentation system that we talked about, let's talk about how wealth transfer can help add to your segmentation. So here's an example. Within your database, we've identified 6 target audiences overall. So again, constituent file, there's 6 core groups that we've identified. Now, when wealth transfer is layered on, 3 of those groups pop up as having high potential for receiving an inheritance this year. One is that young singles and couples group, established families, and then wealthy matures.
Who's that?
Mommy will answer in a little bit, okay, honey? So now when we layer on demographic data, as the target group name suggests, we have 3 very distinct life stage groups. These details will certainly start to help you build a picture on what the priorities might be for these different target groups here. And then again, when you're layering on WealthScapes Fundraiser, you can see where these groups are financially today, which can help guide you on the different programs they may be appropriate at this time. Then factoring in, of course, some of these households may be coming into an inheritance gives you, an additional layer of information in which to approach these different groups or these individuals in your constituent file. Now, lastly, when we overlay Alan's favorite data set, social values, you can start to understand what makes these groups tick. These values can also guide messaging and communication when making that ask. So if we take a look at that Wealthy Matures group, you have legacy, personal control, and community involvement ranked quite high in terms of their core values and beliefs. You can certainly see how if they were to come into an inheritance, how they then may be more open to leaving their own legacy with that inheritance. And with personal control being a top value, offering them different options that they can choose will also benefit. So thank you very much for your time. I'm going to pass things over to Alan to talk to you about donor rank.
Perfect. Thank you, Jen. That's really exciting. Now everybody sees why I'm so excited about WealthTransfer and WealthTrends. There are two new products that can really help fill some gaps in your fundraising efforts and really even add to what I'm about to show you as well. So thank you so much. And thank you, Liam, as well. So moving along into the case study. So we wanted to show how do you make this tangible and what are some of the results that you can be seeing in using one of our newer tools, DonorRank, which was conceived and launched about 14 months ago. So we'll go through an example with one of our clients who asked not to be named, but we're sharing their successes, and that's what they've asked to do. And I guess we start with really what fundraisers want to know. And where DonorRank really can help fill a lot of gaps and drive a lot of the conversation. So what does my pipeline look like? And do I need to invest in acquisition strategy? So do I need to look at Prism? Do I need to look at, driving more events, driving more direct mail, more annual programs? What is the capacity of those in my pipeline? We get asked this question a lot in terms of organizations that want to get into a campaign, that are thinking about getting into a campaign because of their needs. And they just want to know who's in our pipeline, but also what is the capacity of those in our pipeline. And then when we're looking at pipeline, it's how do I prioritize? If I have 10,000 people, I have 20, 30, or even 1,000 people in my pipeline, the question is, where do I start? I only have so many staff that can really pick up the phone and start to build those relationships and make those phone calls. So how do I know which of those prospects in my pipeline or in our database are the ones that I should start with? And that's really what this case study is going to show. So it's looking at, and the client that we're going to be using here really started off by utilizing our demographics, our behaviors, and our attitude data to help them build on acquisition, to build sort of the communication strategy, to understand who's in their database to a degree and how to communicate to them. And then their next challenge was essentially what I called out a little bit earlier, but it's looking at, we need to go into a campaign based on what some requirements are from the hospital, but we kind of want to know what's in our pipeline. So how do we properly strategize things? And how do we look at it by program as well? So it's not just about looking at it holistically, but can we take a deeper dive into each area? And they also looked at or asked the question about, can we also break this up further into ethnic groups? So we have a very diverse sort of community that's around our hospital. So is there a way to dive deeper into that? Because that's part of our general strategy and outreach. And then how do you layer that all on top of all the things that we've started or have been doing with you over the last number of years? So that was the business challenge that was put in front of us. And we smiled and we said, we absolutely can help you answer all those questions. And that's really where DonorRank came in. So DonorRank takes the capacity question, the scoring, and the prospect question. It kind of melds everything together and helps you understand who are your best prospects based on engagement and based on a bunch of other criteria that are particular to your organization. In this case, it was a hospital. So we looked at healthcare variables. We looked at giving to the hospital. We looked at other sort of variables that we pulled in from giving back, as well as social values, which Jen spoke about a little bit. But in other cases, we can also do that for other sectors and other areas to help customize it to be impactful and important to your organization. So it's not one size fits all solution. And really, here's a great depiction of what it kind of looks like if you put everybody into a little melting pot and add some data to it. So from the environic side for this case study, or for this example, we use WealthScapes. we append WealthScapes to donor rank. So you would have that capacity, and that gets into discretionary and disposable. If we're looking for cash minus the debt. If we're looking for blended gifts, you can get into liquid assets plus cash. Or if we're looking for planned giving and tribute giving, we can look at fixed assets. And I know we've talked about real estate on the call and through this webinar. So looking at sort of what does that look like and sort of other fixed assets. We add in behavioral data, apologies. And that's just looking at some different behaviors that this particular group has that might be important. So for this particular case, it was important. Again, looking at giving back, that was the data that we pulled in that looked at people that give to healthcare. So that was really important. We added social values to map back the social values of the organization, plus social values that would be relevant to those that give. So things like leaving a legacy was important. There's a social value around that. Giving back to your community, those types of social values were sort of married and brought into the mix. And then last but not least, we used our origins data that can help on the diversity side. So we were able to break all the different sort of groups of the constituents based on diversity and ethnic backgrounds that help break that up a little bit further. And that was added, as I mentioned before, to an engagement score. So engagement scores sometimes are things that we use that organizations have pre-developed. And in some cases, we develop them for you. And that could be marrying engagement frequency. So how many times do people come out to events? Could be frequency on gifts, could be size of gifts, could be a whole different list of things. And that's something we have discussions with you with. And the depiction on the right showcases sort of really what that looks like in terms of a database. In this case, it was 30,000 people. We put it through the mix and through donor rank, and then we were able to group people in terms of their the approach and starting with the best, which would have been marked as 5. And those are the people that you want to start to target and start to group out based on the different program that you have. And that really leads us to donor rank. The tool itself is something that we're very proud of because it is a very simplified, one would say, model where it's based on an Excel or put into an Excel format that is easy to toggle and again looks at our privacy friendly sort of approach where we look at system ID. So whatever system you use, we want to make sure that we can map it to that. A city or town name, a postal code, and then an engagement score comes from your database. And then we use a bunch of different variables and sort of a formula based on what the objective is to create the ranking, which is found on the right. And anybody can use Excel. Well, mostly anybody. And for this case study, in this particular example, what we did find and some interesting insights, which usually do vary from organization to organization, was the pipeline was actually quite healthy. They've built up a great pipeline from all their events, from all their annual giving and all their acquisition sort of strategies. So they had a good pipeline to start off with. So they didn't have to do a huge push on acquisition right off the bat. The second part was there were a lot of mid-level major gift donor prospects flying under the radar. So they were looking to the right and their donors were to the left. They were looking at people that probably were a little bit more obvious. So that's what we all naturally do. And that sort of didn't help that they had all these great prospects that they can go after that they were just missing. And that's where donor rank helped out. So they were focused a little bit on the wrong donor prospects, or not the ones that would give them the best return or help move the program in terms of volume. So the results at the end, I'm going to skip over the overall part and just get into the results first. The results we've identified through this project and donor rank that they had about 110, just over 110 major gift prospects that were new and identified that weren't on the radar at all before. From the mid-level prospect side of things, there were over 300 people that they were missing and weren't talking to. So they quickly put those sort of into a process and added the demographics and behaviors and social values to also look at how do we approach these people. So that can also help sort of truncate a little bit of that fundraising process as well. So we added a lot more people into their pipeline, or identified a lot more people in their pipeline that they should start focusing on. And we broke that up by the different ethnic groups and we distributed across. The other aspect that we gave them was now they could track year by year how their fundraising campaigns were doing based on their pool of donor prospects. And also we were able to then go a little bit more granularly and look at the different fundraising programs and areas that they had. So if we're looking at research, or we're looking at particular equipment or general fund or whatever else was associated with the campaign, we were able to break all of that down for them so they can also look at not just holistically what the campaign looked like, but if they needed to focus in a particular area, do they have enough in the pipeline to focus in that particular area, and what would it take? And or is there an acquisition portion for that particular program? So that was some great results. We're super happy the donor rank really helped them out and really got the ball rolling and added to all the other aspects of the data that they already had. Just thinking about what Jen kind of presented in WealthTransfer, that is another great tool that could be added into donor rank to help sort of geo-target a little bit better those that are about to inherit, and or we can have flags that look at those that will sort of pass on a gift to a different generation. So we can kind of look at it both ends of the spectrum, and that kind of adds to what donor rank can really do and how it can sort of power your fundraising efforts. So with that, I'm going to say thank you so much for spending the last little bit with us and looking at sort of how the financial state of Canadians has been going pre-pandemic. So walking into 2020, as well as the first 3 quarters of 2020 and how we've been doing, as well as giving us an opportunity to showcase 2 new products that we're so excited about, WealthTrends and WealthTransfer, as well as donor rank, and showcasing how the tool could be used to help you in your fundraising efforts. So thank you so much for spending your time with us. And if you have any questions, please feel free to reach out to me. My information is here, as well as Jennifer, who we're happy to provide more information on as well.